The Federal Reserve, Fed, faces a delicate balancing act when it comes to raising interest rates to combat inflation while avoiding adverse effects on the banking industry. Here's how the Fed navigates this trade-off. 1. Inflation control, raising interest rates. Primary goal, the Fed raises interest rates to control inflation. By increasing the cost of borrowing, it slows down consumer spending and business investment, which helps cool demand and reduces price pressures. Monetary policy. The Fed uses its dual mandate to focus on price stability and maximum employment. During periods of high inflation, maintaining price stability takes precedence, prompting rate hikes. Inflation expectations. If inflation persists for too long, inflation expectations can become entrenched, leading to a wage price spiral. The Fed raises rates to prevent this, ensuring inflation doesn't destabilize the economy in the long term. 2. Impact on banking industry profitability. Higher interest rates can reduce the profitability of banks in several ways. Interest rate mismatch. Banks may have long-term loans, such as mortgages, with low fixed rates. As interest rates rise, the cost of short-term funding increases, squeezing margins. Loan demand. Higher rates often dampen loan demand, impacting bank revenues from new loans. Credit risks. Higher borrowing costs can lead to more defaults, particularly if businesses or consumers struggle to service debt at higher rates. Liquidity concerns. The value of banks' bond holdings, typically in treasuries, declines as rates rise, which can create liquidity pressures, especially for banks reliant on bonds for collateral. 3. The Fed's decision-making process, data-driven. The Fed relies on economic indicators, such as inflation data, PCE, employment statistics, and financial stability reports, to gauge the trade-offs. A strong banking system is crucial, but price stability remains a key focus. Gradual approach. To avoid destabilizing the financial system, the Fed may take a more gradual approach to raising rates, allowing banks and markets time to adjust. Stress testing. The Fed uses stress tests to assess how banks can handle economic downturns and rising rates. If systemic risks appear too high, they may pause or slow rate hikes to protect financial stability. Communication. Forward guidance plays a role in managing expectations. The Fed carefully communicates its plans to ensure markets, including banks, can adjust gradually without sudden shocks. 4. Other tools to balance impact. Targeted liquidity measures. The Fed can provide liquidity support to banks through mechanisms like the discount window or repurchase agreements, repos, if the banking sector shows signs of stress. Regulatory relief. In extreme cases, the Fed can ease certain regulations to provide temporary relief to banks if rising rates significantly threaten the sector. Ultimately, the Fed will aim to balance inflation control with ensuring financial stability. If inflation is high and persistent, the Fed is likely to prioritize price stability, but it may adjust the pace of rate hikes if it detects systemic risks in the banking sector.